I want to bring in our guest to help us walk through all this, Larry Shover. He's the Chief Investment Officer at SFG Alternatives. Larry, I've been looking forward to our chat because you and I were tweeting back and forth, and I like what's on your mind today. Let's start with bonds, because for those that haven't been keeping score, back in February, you said careful before you say 3%. Bonds then got some strength down to 2.7.5. Now what comes, Larry? What are you looking at?
Well, clearly oversold, but I know that's a two-edged sword, and that's easy to say. But when you look at inflation break-evens, heavy issuance, other than that, there's no reason for the yields to be where they are. And so I respect the move. The move came out of nowhere. It definitely hurt a little bit, but I still remain constructive and look to get long and continue to think that we're going to see 2.5 to 2 3/4 by year end, keeping well in mind that we're 2 basis points away from where we were in 2011.
Yeah. Larry, here's what I'm curious about, which is what's different now versus the start of the year, because I see some things. One is that you now have the dollar that's participating on the upside as well. The relative economic strength here is a little bit better. Now, you made the point on Twitter that I responded to, which was that the economic data this week, there's not much of it. We're going to get a print for GDP on Friday, but this trajectory for the 3% is happening on not a lot. What does it tell you?
It tells me that we're just in a short covering mode. I'm not trying to make myself feel better because I do think rates will go lower, but you're right. I mean, break-evens have climbed a little bit with the price of oil, and there was huge auction yesterday. Yesterday's 2-year auction was the biggest since 2014. So when you piece those together, I'm really stretching to find a reason why yields have backed up as much as they have. I think it's just shaking people out through these psychological levels, and I still remain constructive that yields be lower than higher at the end of the year.
Interesting. All right, so Larry, continuing this look, my chart of the day is just a simple S&P versus the 10-year year-to-date. And as we talked about the strength that came back into bonds from late February to early April, there were a lot there that, in terms of catalysts, that have kind of dropped to the background. If we don't hear about tariffs, or if it gets resolved, or if you have an overall risk environment that doesn't seem concerning on the geopolitical front, what's to stop these yields from continuing to move higher? I mean, one could look at that timing and say, hey, all the buying that happened in bonds happened because of these geopolitical tensions.
Yeah, I think you just went into the background a little bit, and you're right, the geopolitical tension definitely caught people's notice, caught people off guard. But I think what's going to stop them is just really the relative performance of the data. And let's be frank that since January, macro data has fallen off a little bit. It's stalled out. I mean, it's definitely stalled at a very high level. I don't think it's anything to worry about per se, but I think it's going to keep us from going much higher. And also, we have to bear in mind that real rates are still negative, and they're still deeply negative. There hasn't been a correction in the stock market until real rates get up to near 2%. We're a long way from that.
What's interesting, Larry, I want to get your take on this too, because the other point of the S&P versus 10-year chart that I'm looking at is the fact that S&Ps have weakened now for several days straight, even despite big earnings beats. There's not a lot of buying happening on the benchmark level. If that's not pushing a safety trade into bonds, or really pushing a safety trade into gold so much, then it seems tough, at least in terms of what could potentially move bonds stronger. It's not going to be weakness in the stock market.
No, I don't think it will be, at least not here. I mean, obviously, if we get inflation out of nowhere and we get pressure on margins, which we definitely are not, then that would signal the end, or at least a cycle end. I mean, right now, I think consensus does have confidence in the fundamentals. And what we're arguing about right now is confidence over the cycle. When is this going to end? When will we see a recession? And I still think we're a ways off. I mean, think about the earnings season. Consensus is saying 15% year-on-year growth in the first quarter, even 9% when you take out all the taxes. Revenues are the highest they've been since 2014, and that's huge. We just talked about revenues and how the biggest problem is when companies have to squeeze that to be profitable. And Caterpillar, of all companies, really did have a good earnings report. And the silver lining in it all is that they have temporary cost pressure trying to meet that demand. So it's an evolving story, but one now that we have to just kind of tread water through.
Yeah. Larry, last point real quickly, about 30 seconds. Is there a piece of economic data or is there a indicator that will make you reconsider, that'll say the move past 3 is for real this time?
No, not. I mean, yeah, of course. I mean, if GDP, one data point doesn't make a thesis for me, but GDP combined with the next ISM report and the labor report, you start stringing those together, then yeah, of course. But I just think that how much money is on the sideline, the velocity of money, M2 where it is right now, I just can't see rates, much higher than 3 1/4, and I think break even is like 2 3/4.
All right, Larry Shover, always great to get your take. It's a good conversation when you can stay in one asset the entire time. Larry Shover joining us from the CME, the Chief Investment Officer of SFG Alternatives. Great to chat with you, Mr. Shover.